Hey there, crypto warriors and digital asset enthusiasts. Welcome back to Boni's Life. Today, we're dissecting what I like to call the Great Consolidation Tango, a market dance where Bitcoin flirted with both bulls and bears while institutional giants made moves that would make even the most seasoned traders do a double take. We've got Circle's IPO making waves bigger than a tsunami in a teacup, JPMorgan pulling a complete 180 on crypto. That's more surprising than finding out your grandmother is secretly a Bitcoin maximalist, and Cathie Wood dropping price predictions that would make even the most optimistic crypto enthusiast need a moment to catch their breath. So grab your favorite beverage, settle in, and let's unpack the past 24 hours in crypto markets with the kind of analysis that would make both Wall Street veterans and DeFi degens nod in approval. Trust me, by the end of this episode, you'll understand exactly why this seemingly quiet period might be the calm before a storm that could reshape the entire cryptocurrency landscape. Let's start with the numbers, because in crypto, numbers don't lie, though they certainly know how to keep us on our toes. As of our recording, Bitcoin is trading at $105,475, showing a modest but meaningful 0.21% gain over the past 24 hours. Now, I know what you're thinking. Boni, that's barely enough movement to get excited about. And you'd be right if we were talking about traditional assets. But in the crypto world, sometimes the most significant moves happen in the spaces between the obvious. This $221 increase might seem small, but it represents something far more important: stability in the face of uncertainty. Bitcoin's market capitalization sits comfortably at $2.09 trillion, with a 24-hour trading volume of $41.47 billion. These aren't just numbers on a screen. They're indicators of a market that's maturing, consolidating, and preparing for its next major move. Ethereum, our favorite smart contract platform, is holding steady at around $2,622, up a modest 0.11%. What's fascinating here isn't the price movement itself, but the fact that Ethereum is maintaining its ground while the broader market experiences what technical analysts call sideways consolidation. It's like watching a master chess player carefully positioning their pieces before a decisive move. The total cryptocurrency market capitalization stands at $3.31 trillion, a number so large it makes most national GDPs look like pocket change. The 24-hour market cap change of positive 0.08% might seem insignificant, but it represents billions of dollars in value stabilization across thousands of digital assets. But here's where it gets interesting, and why I always tell my viewers to look beyond the surface numbers. This consolidation is happening against a backdrop of unprecedented institutional activity, regulatory clarity, and macroeconomic conditions that are creating a perfect storm for the next major crypto market movement. The question isn't whether we'll see significant price action soon. It's which direction it will take us. Now, let's put on our technical analysis hats and dive into what the charts are really telling us. And before you ask, yes, I do own an actual technical analysis hat. It's surprisingly comfortable and makes me feel 23% more confident about my predictions. Bitcoin's current position at $105,475 is particularly intriguing from a technical perspective. We're seeing what I like to call the calm before the algorithmic storm. The relative strength index is sitting at a comfortable 62 on the 4-hour chart, which means we're in that sweet spot where the asset isn't overbought, but has enough momentum to suggest upward potential. The 50-day moving average which has been acting as a crucial support level, recently hit a record high. This is significant because it indicates that the underlying trend remains bullish, despite short-term volatility. Think of it as the market's way of saying, I might be taking a breather, but I haven't forgotten how to climb. What's particularly fascinating is the hash ribbons indicator, which has just flashed a buy signal. For those unfamiliar, this indicator tracks Bitcoin mining activity and historically has been remarkably accurate at identifying major market bottoms and the beginning of new uptrends. When miners are under pressure and potentially forced to sell, it often creates buying opportunities for savvy investors. On-chain metrics are painting an equally compelling picture. Glassnode data shows a 15% increase in Bitcoin wallet addresses holding over 1 BTC in the past 48 hours. This isn't just random accumulation, it's strategic positioning by larger players who understand that supply dynamics are about to become increasingly favorable. The trading volume patterns are also telling a story. We've seen a 25% jump in Coinbase trading volume to $5.8 billion, and Binance's BTC USDT pair experienced a 22% volume increase following recent market catalysts. This isn't panic buying or selling, it's calculated positioning by institutional and retail investors who recognize the current market setup. From a macro-technical perspective, Bitcoin is forming what appears to be a symmetrical triangle pattern on the daily chart, with decreasing volatility suggesting an imminent breakout. The direction of this breakout will likely be determined by the fundamental factors we're about to discuss. But the technical setup suggests that when it happens, it will be significant. Moving from charts to fundamentals, we need to talk about the elephant in the room, or should I say the institutional whale in the digital ocean. The past 24 hours have delivered fundamental developments that are reshaping how we think about cryptocurrencies' place in the global financial system. Let's start with the Circle IPO, which priced at $31 per share, valuing the USDC stablecoin issuer at $6.9 billion. This isn't just another tech company going public. This is a cryptocurrency infrastructure company achieving a valuation that puts it in the same league as established financial institutions. The fact that the offering was oversubscribed by 25 times tells us something profound about institutional appetite for crypto exposure. But here's the kicker. Cathie Wood's ARK Invest is planning to purchase approximately $150 million worth of Circle shares. When one of the most respected technology investors in the world puts that kind of money behind a crypto infrastructure company, it's not just an investment, it's a statement about the future of digital finance. The supply dynamics story continues to be one of the most compelling fundamental arguments for Bitcoin. With only 1.13 million Bitcoin remaining to be mined over the next 115 years and institutional demand accelerating, we're looking at a supply-demand imbalance that would make oil traders jealous. Cathie Wood's recent analysis highlighting that 95% of investable capital remains unexposed to Bitcoin, while 95% of the supply is already in circulation, creates what economists call a perfect storm scenario. Corporate Bitcoin holdings are approaching $85 billion, more than doubling in just 1 year. This isn't speculative buying. This is strategic treasury management by companies that understand Bitcoin's role as a hedge against currency debasement and inflation. When corporations start treating Bitcoin like digital gold, it fundamentally changes the asset's risk profile and long-term trajectory. The regulatory landscape is also evolving in ways that favor institutional adoption. Hong Kong's decision to allow crypto derivatives Trading opens up new markets and legitimizes cryptocurrency trading infrastructure. Meanwhile, the ongoing discussions around stablecoin regulation in the United States are creating clarity that institutions need to feel comfortable with larger allocations. Perhaps most importantly, we're seeing the emergence of what I call crypto traditional finance convergence. JPMorgan's decision to accept Bitcoin ETFs as loan collateral, which we'll discuss in detail shortly, represents a fundamental shift in how traditional banking views cryptocurrency. When the largest bank in the United States starts treating Bitcoin ETFs as legitimate collateral, it's not just a policy change. It's a recognition that digital assets have achieved institutional-grade legitimacy. Now let's zoom out and examine how global events are creating the perfect macroeconomic environment for cryptocurrency adoption and price appreciation. The past 24 hours have delivered a masterclass in how traditional financial system weaknesses become cryptocurrency strengths. The US dollar is experiencing its weakest performance since 2017, down approximately 9% year to date and sitting at 6-week lows. This isn't just a temporary blip. It's the result of fundamental economic pressures that are driving investors toward alternative stores of value. When the world's reserve currency shows signs of structural weakness, Bitcoin's value proposition as digital gold becomes increasingly compelling. The economic data coming out of the United States reads like a cryptocurrency bull's wish list. The services sector contracted for the first time in nearly a year. Labor markets are showing signs of easing, and private payroll growth came in far below expectations. Normally, this would be concerning economic news. But for Bitcoin investors, it represents the kind of macroeconomic uncertainty that historically drives adoption of non-correlated assets. Federal Reserve policy expectations have shifted dramatically, with markets now pricing in 56 basis points of rate cuts this year and a 95% probability of easing in September. Lower interest rates reduce the opportunity cost of holding non-yielding assets like Bitcoin, while simultaneously increasing the appeal of assets that can't be debased through monetary policy. The European Central Bank is expected to cut rates by 25 basis points, marking the 7th rate cut in 13 months. This global monetary easing creates an environment where hard assets with fixed supplies become increasingly attractive. When central banks around the world are essentially competing to devalue their currencies, Bitcoin's 21 million coin limit starts looking like the smartest monetary policy ever designed. Trade uncertainty between the United States and China continues to create market volatility and drive demand for assets that exist outside traditional geopolitical frameworks. Bitcoin's borderless nature and resistance to government control make it an attractive hedge against trade war, uncertainty, and currency manipulation. But perhaps the most significant global development is the accelerating institutional adoption we're witnessing across multiple jurisdictions. From Hong Kong's crypto derivatives approval to the European Union's continued development of comprehensive cryptocurrency regulations, we're seeing a coordinated global effort to integrate digital assets into traditional financial systems. The profit-taking we've observed in traditional crypto markets, with assets like Dogecoin and Cardano leading declines, actually represents healthy market behavior. It suggests that the market is maturing, with investors taking strategic profits rather than engaging in panic selling. This kind of rational market behavior is exactly what institutional investors want to see before making larger allocations. Let's dive into what the smartest minds in cryptocurrency and traditional finance are saying about current market conditions, because sometimes the best insights come from people who've been watching these markets longer than most of us have been awake. Michael Saylor, the executive chairman of MicroStrategy and arguably Bitcoin's most vocal institutional advocate, recently tweeted, "The future is be right." Now, you might think this is just another bullish tweet from a known Bitcoin maximalist, but Saylor's statements carry weight because they are backed by over $14 billion in corporate Bitcoin holdings. When someone has that much skin in the game, their public statements become market-moving events. What's particularly interesting about Saylor's recent commentary is the timing. He is doubling down on Bitcoin optimism during a period of consolidation, which suggests he sees current price levels as accumulation opportunities rather than distribution zones. His company's continued Bitcoin purchases, even at six-figure price levels, indicate a conviction that current prices will look cheap in retrospect. Cathie Wood's recent analysis provides perhaps the most compelling fundamental argument for Bitcoin's long-term trajectory. Her statement that this is just the beginning for Bitcoin isn't hyperbole. It's based on rigorous analysis of supply and demand dynamics. Wood's updated price targets of $300,000 to $2.4 million by 2030 might sound aggressive, but they're grounded in mathematical reality when you consider the supply constraints and growing institutional demand. Wood's observation that 95% of investable capital remains unexposed to Bitcoin while 95% of the supply is already in circulation creates what she calls an inevitable supply-demand imbalance. When institutions finally arrive at scale, they'll be competing for a diminishing supply of available Bitcoin, creating upward pressure that could dwarf previous bull markets. The most surprising development, however, comes from JPMorgan Chase. The bank's decision to accept Bitcoin ETFs as loan collateral represents a complete reversal from CEO Jamie Dimon's previous skepticism about cryptocurrency. This isn't just a policy change. It's a recognition that Bitcoin has achieved the kind of institutional legitimacy that makes it suitable as collateral for traditional banking products. JPMorgan's move is particularly significant because it bridges the gap between traditional finance and cryptocurrency in a way that creates new use cases for Bitcoin ownership. When you can use your Bitcoin ETF holdings as collateral for traditional loans, it fundamentally changes the risk-reward calculation for holding the asset. You're no longer choosing between liquidity and Bitcoin exposure. You can have both. Bitwise CIO Matt Hogan's analysis adds another layer to the institutional adoption story. His observation that 95% of Bitcoin is already in circulation while 95% of investable capital remains unexposed highlights the asymmetric opportunity that still exists in cryptocurrency markets. This isn't a mature market with limited upside. It's a market in the early stages of institutional discovery. The technical analysts are equally bullish, with on-chain metrics showing a 15% increase in Bitcoin wallet addresses holding over 1 BTC in the past 48 hours. This suggests that larger players are accumulating during this consolidation period, positioning themselves for the next major move higher. So what does all this mean for the future of cryptocurrency markets, and how should investors position themselves for what appears to be an inevitable shift in market dynamics? The convergence of factors we've discussed creates what I call a perfect storm scenario for cryptocurrency adoption and price appreciation. We have weakening fiat currencies, accommodative monetary policy, increasing institutional adoption, improving regulatory clarity, and supply dynamics that favor long-term holders. When all these factors align, the result is typically explosive price action. The short-term outlook suggests continued consolidation with a bullish bias. Bitcoin's technical setup indicates that we're in the final stages of a symmetrical triangle pattern, with a breakout likely in the coming weeks. The fundamental backdrop strongly suggests that this breakout will be to the upside, potentially targeting the previous all-time high around $111,980 and beyond. Medium-term prospects are even more compelling. The institutional adoption cycle is just beginning, with JPMorgan's collateral acceptance representing the tip of the iceberg. As more traditional financial institutions develop cryptocurrency products and services, we'll see increased demand from investors who previously had no access to digital assets. The regulatory environment continues to improve, with clear frameworks emerging in major jurisdictions. This regulatory clarity removes one of the primary barriers to institutional adoption and creates the foundation for even larger capital allocations to cryptocurrency. Long-term, the supply dynamics story becomes increasingly compelling, with institutional demand accelerating and supply growth slowing due to the halving cycle. We're approaching what Cathie Wood calls an inevitable supply-demand imbalance. When this imbalance reaches critical mass, the resulting price action could dwarf previous cryptocurrency bull markets. For investors, this environment suggests a strategy focused on accumulation during consolidation periods and patience during volatility. The fundamentals have never been stronger. The institutional adoption cycle is accelerating, and the macroeconomic environment favors hard assets with fixed supplies. The key is understanding that we're not just investing in a speculative technology. We're positioning ourselves for a fundamental shift in how the global financial system operates. Bitcoin and other cryptocurrencies are evolving from speculative assets to essential components of modern portfolio construction. As we wrap up today's analysis, I want you to remember that the most significant market moves often happen during periods that seem quiet on the surface. The past 24 hours might not have delivered the dramatic price action that makes headlines, but they've provided something far more valuable. Confirmation that cryptocurrency is transitioning from a speculative asset class to an essential component of the global financial system. The institutional adoption we're witnessing, from Circle's successful IPO to JPMorgan's acceptance of Bitcoin ETFs as collateral, represents a fundamental shift in how traditional finance views cryptocurrency. When the largest bank in the United States starts treating Bitcoin as legitimate collateral, it's not just a policy change. It's a recognition that digital assets have achieved institutional-grade legitimacy. The technical setup suggests we're approaching a significant breakout. The fundamentals have never been stronger, and the macroeconomic environment continues to favor hard assets with fixed supplies. For those who understand these dynamics and position themselves accordingly, the coming months could be extraordinarily rewarding. Remember to like this video if it helped clarify the current market situation. Subscribe for more in-depth cryptocurrency analysis and hit that notification bell so you'll never miss our latest insights. The cryptocurrency market never sleeps, and neither does our commitment to bringing you the most comprehensive analysis available. Until next time, this is Boni, reminding you to stay informed, stay rational, and most importantly, stay positioned for the future of finance. The revolution isn't coming, it's already here, and those who recognize it early will be the ones who benefit most from the transformation ahead.